exclusive trading pit, your home for sophisticated takes on the crypto markets. It's June 11th, and here in the brand new XC studio is JJ and Ben Lilly of JLabs. I am your host, Marconi Wine. Today, we're asking how long can Bitcoin's price stay pinned under a new all-time high? But first, it's rapid fire, where I look for simple answers to unbelievably complex questions. Let's get started. Gentlemen, I hope you guys are enjoying the brand new studio we have here. You know, I and myself and the producers have been working on this long and hard. I know you guys have had some input as well, but let's get going on these questions. And welcome to everybody who's in the studio. It's amazing to see you guys here. First one, JJ, Roaring Kitty, savants are just stupid. JJ, you with us? Or you playing coy? Oh, we got a little bit of silence. Producers, help us out here. By the way, we are doing destructive testing right here in production, so if this doesn't go as planned, we know who to call out. Ben, I'm going to go on with you. You're comparing.
Sir.
Okay, you're comparing chains. Solana versus ETH or Solana versus Base. What is the right comparison?
That it's going to be Base right now, based upon the narrative that they're looking to grab, as well as the fee structure. Solana, it has a bit of a way to go to have that comparison to ETH because it doesn't have kind of that L2 ecosystem being built around it.
So wait, so am I hearing you correctly? Base is the right comparison right now?
Yes, sir.
Okay. All right. So for all you trying to do your analysis, that's where you need to look at. JJ, are you back with us?
Can you hear me?
Oh, I can hear you now. Oh, that
Awesome.
sweet voice. All right. Let's get back to the first question. Roaring Kitty, savants are stupid.
Savant until proven otherwise. The man's turned whatever it was, 30,000 into 100 million or something like that. So until it goes the other way and he's bankrupt, I'm going to say Savant. It seems like he's playing chess.
He does seem quite amazing, actually. I don't know how else to say it. I did watch, I think, an episode or video for him for 3 years ago where he's talking about his trading strategy. He's using cards and a magic 8-ball, so it was quite sophisticated.
The funniest thing I saw was the interview last week. I forget who it was, some short seller on CNBC talking about why he short GameStop, and the amount of just seething anger that this guy had for it was pretty comical.
Oh man. Yeah, I love to see the people's heads explode.
Yep.
Ben, do ETFs and institutions blow off bubbles and blow off tops?
In 2017, we kind of saw that happen. So is it going to happen this time around? Likely. There's going to be opportunity and arbitrage that rears its head, and somehow that's going to get squashed out because it'll just be a different form of returns and yield that exists that isn't a price directional type of bet. So absolutely.
Okay. So, but to consider if you're looking for parabolic blow-off tops. All right, JJ, last question here, and we're going to get it strong into the analysis. What happens first, a new all-time high or retail returns?
I think all-time high comes first. If you think about it in terms of 2020, once the Fed printed all that money, it takes a while to circulate through the economy, right? It's like the Cantillon effect, if you want to call it that, in that money goes to rich people first. They drive up the price of assets, and then eventually it trickles down to retail people who aren't typically in markets. They find themselves with excess cash due to the influx of printing, and then they finally join markets after they're already at all-time highs. So I think that's probably a good model to follow there. Retail probably return somewhere around 100K.
And then get pissed off when they bought it at 100. Okay, well that's that's a side story. All right, well let's get going on because we have some very interesting topics today. Even though it feels like a bit of a slow news week, we got outside forces that are looking like they just want to take over risk assets as the Dixie rolls higher. I was looking at that this morning. JJ was about 105. I think we have some interesting commentary from you, Ben, about the rates, and even some our favorite Senator Warren has been asking when they're actually going to lower them. And then I think if we go a little bit further, I want to get to understanding what this basis trade means. And is it actually the reason that we're pinned below our all-time high? Before I do, I do want to give a shout out to everyone who's joined us in on Cyber. And for those who are watching this on YouTube later, we are in the new studio. I hope you like the new digs. If you come and join us every Tuesday and Thursday, you can join us live in the On Cyber room where we have the show and you can ask questions just like we've done on YouTube. But now we're in this brand new studio where you can join your avatar. I think someone mentioned It felt a little bit like Counter-Strike 1.6 with the dances. So just know that if you join us here, you can dance, which we know is really what you want to do when you hear the commentary. Um, we'll keep a link in the description. Let's get into it though. So JJ, break down what you're seeing right now from the dollar. For our last week and a half, we were looking at that 104 to 105 range, kind of expecting this to break down. It looked like it was on the verge of going below that 104. Now it looks like we've got a lot of strength and we're seeing a little bit of a pullback in Bitcoin. Walk us through what you're seeing from the Dixie and when is this going to actually, relent?
Yeah, the train has left the station, huh? It came down to test that 104 mark that we were saying was kind of line in the sand. Below that, I think we would have seen all-time highs. That's kind of the fuel the market was looking for. But Friday's employment report came out the other way, strengthened the dollar, and now we just see it on an absolute tear. Went from one Bollinger Band here on the daily all the way up to the other, and that's just it's broken above all these major moving averages. It's not the sign you wanted to see towards the end of last week. I think there's a window of opportunity to exit there around 71K. It gave it to you for a few hours and it didn't last long, right? We just have seen the market meltdown in reaction to this. There's that kind of slow lag effect when you see these strong dollar moves. It does give you an opportunity to act, but it's not a long lasting one, right? Like it only gives you so much time. And it left the station on Friday and it's just ripping right now. What happens tomorrow is anybody's guess. This is not the kind of strength you want to see. We've undone basically all of the bearish price action since last month's CPI. So here's where we were the Tuesday before CPI in May. And then we saw it melt down, fall towards that 104 range. And now it's bounced back and it's all the way back up to where it was. So this is a pretty bullish engulfing structure here. What happens tomorrow is anybody's guess, but it's not looking too favorable right now.
All the technicals look very strong. Ben, I want to ask you to come up here, talk a little bit about the narrative. I think tomorrow we have the FOMC results coming out. We have inflation coming out. So we have some macro information coming out. It really feels month to month. I mean, JJ just mentioned we've really taken out all the bear structure since last month. I think the current reading that I'm hearing from a narrative perspective is that there's really no reason to cut rates right now when we look at jobs, when we look at inflation. What do you say? And then I mentioned earlier, Elizabeth Warren sent out a letter, I think with someone else who was asking why haven't they cut rates? So walk us through what you're seeing and what's the concern here? I mean, is there any possibility we're actually going to see some rate cuts?
I think that's coming. I do. And if anything, I believe there were some cracks that were starting to show when it came to the economy. There was a interesting stat of essentially foreign-born employment figures versus non-foreign in the U.S. And it was pretty stark contrast where those that were born within United States and kind of the employment levels were stagnant, and those that were foreign-born, those employment levels have risen and is responsible for essentially all the employment growth of late that everybody seems to be hanging their hat on. And when you lower your costs of employment, which this is a pretty general kind of analysis here, is that those workers coming in, they're seeking better opportunities, and you're able to essentially, for those that have been born in the U.S. working for a long time, you're able to reduce your costs, reduce your wages, and that is a way to combat inflation. And because you're reducing your costs, that's creating more productivity in the economy. And that's kind of why analysts have been underestimating GDP, and it's been a surprise to the upside. So I think there's starting to be some holes poked into this whole discussion that Bidenomics is not as strong as Democrats are led to believe. And what I found kind of interesting, and I'm going to pull this up before I get into the discussion on kind of what JJ's hitting on with the DXY. I didn't mean to bring that one up, but I meant to bring in Elizabeth Warren's letter. Looks like the highlighting has left, but what was interesting here is,
all right.
well, I highlighted this whole piece of text that I wanted to bring up because she actually goes ahead and admits that the economy is not as strong. It's right at the beginning. This sustained period of high interest rates is already slowing the economy and is failing to address the remaining key drivers of inflation. So right there, she's breaking from her party's narrative that she's saying that the economy is slowing and it's not as strong. And so you could see that the holes being poked are starting to kind of percolate elsewhere. And Elizabeth Warren kind of just did it here But what I mean, this is kind of disgusting, is because she doesn't really pass legislation, right? She's been there for a long time. She just grabs the mic, grabs your attention, gets some comments in, and then moves on. She's essentially the I know we don't like to curse here, but she's the shit poster of Congress
Ooh,
in a way.
calling out Miss Warren.
Right? So when
It's a
she
valid
writes this
analogy.
letter, yeah, she's trying to get that soundbite in. And so she sits in kind of financial committees. And when Powell actually does go ahead and makes a cut or two, she's going to go, "Hey, look, my letter, I am the responsible person for this. I saw the economy was slowing. I acted. It was me, right? Like, that's Elizabeth Warren for you. This is case in point." Okay. But as far as like why now, why is the timing happening? It's because rate cuts are likely to be approaching. The timeliness is not a coincidence here with this letter and the possibility of
So,
rate cuts
s-
happening. Because
Ben, yeah, let
for,
me get in there. Are
yeah,
you suggesting that this is more of a signal rather than a request? She's more signaling like, hey, these are coming down the pipe. I want to sound as if I'm getting ahead of it, but really this expectation's building. This is going to happen anyways.
it's a proof point for her around election season. I don't know if she's actually up for election, but it's just a good proof point that she can point to and say, "Look, I'm the one that went to bat for Americans
Hmm.
everywhere and said, we need a stronger economy. And I went ahead and I worked so hard to write this letter. And I'm the one that was responsible for these rate cuts." And the reason she's doing it is she kind of can read the tea leaves that the rate cuts are
Yeah,
coming. So this becomes that easy victory that she can pat herself on the back, that she is literally not doing anything
sure.
for. Like, it's already coming. But what I do find a little bit, I kind of want to say conflicting, is the rate probability. So the expectation of what rates will become at certain points in time in the future. And so June, the expectation is unchanged. So it's all, again, about to be commentary. What does Jerome say in the presser afterwards? Is he going to lean into this hawkish narrative? Is he going to ease up? I have a feeling he's going to be a little bit dovish, to be honest. And the reason being is I like to look at rates as like this mean reversion. For a while, we were discussing earlier this year that, hey, the discussion needs to happen, that the possibility for rates to go up just need to enter the picture. And we eventually got that. And then once that happened, he kind of that kind of left the table, right? We didn't really hear any more of that since that point in time. So we mean reverted back to kind of leaving rates unchanged. And now we're back to kind of this discussion of when rate cuts are coming. But if you look here, this is July. July and September are the two main dates to keep in mind here for when we might have a cut take place. And if we look at July, over the last month and even in the last week, we've seen this probability change just in the last week, 82% to 91%. So this is rates remaining unchanged in July. That probability just jumped from 82 to 91. So the thinking is that rates will be unchanged in July, meaning the dollar will be a little bit stronger as a result of that. And we saw that painted on the chart as well. And so then if we look at September, pull it up here, we can see that same thing that is kind of moving the needle, but now we're 50-50. So this becomes that line in the sand in September for where we need to be looking towards. And I think Jerome, after tomorrow, he's going to really move the needle on this percentage change here, the
Okay,
probability.
so let's just get into like, brass tacks on this. If we're not expecting a rate change tomorrow, Dixie is looking extremely strong. It sounds as though we've got a summer of a heavy Dixie and a lot of weight on risk assets.
Uh, for JJ's analogy, this is the powder keg. Yeah, if the DXY is to lose steam at any point in time here, in almost being priced in, you're going to see that painted on the chart, and it shouldn't be. It's not going to be subtle.
Yeah.
I don't think. I think it'll be And I don't even think
You already
abrupt
see
is the
it,
right
right?
word. I think it'll just be like forceful, continuous, like momentum.
I mean, I think we were always going to see some level of de-risking ahead of, like, you have CPI and FOMC. It's very unlikely that people are going to carry huge amounts of risk into that event, right? But now we're kind of at this crucial inflection point. You could see it pretty clearly here on the daily, where we're basically clinging on to life support here. We're at the bottom end of this Bollinger Band. We're at the 100-day moving average. Just below that is the 50-day moving average. And you don't want to see price gaining traction below 66K. That's when that's going to open up new lows, I believe. I think that's kind of the path to 60K, is if this starts to give way, we see increased spot volumes, possibly funding turns negative. That would kill the cash and carry trade that's been so popular. You would see that unwind. Like, there's a whole lot, and that's why we describe this as a powder keg, is that these conditions could change very rapidly, to where right now you have a lot of people that have been longing spot, shorting the futures, and if funding goes negative, I think a good deal of that unwinds, because that premium's no longer there, right? That risk appetite and liquidity is sucked out of the market due to a strengthening dollar. There's just a whole lot that could go wrong to the downside from here.
That's a little bleak. I'm not gonna lie.
That
What
said,
about
we're at, like, you never want to be ultra bearish at what is to support, right? This is a
yeah?
support level. Same way you don't want to be bullish at resistance, you don't want to be bearish at support. So you have to just take the next couple days with an open mind, because it's going to be choppy. It's most likely going to be volatile, and kind of see where the dust settles towards the end of the week around Friday. And I think we'll have a clearer picture of what direction we're headed. And I'm not saying we're heading, straight to 40K in a straight line. I think there will be time to act, similar to the way there was that window of opportunity to act on Friday. We got that hot employment numbers, and you could have exited at 71K, right? You saw that strength from the Dixie immediately in the pre-market, and that was your warning signal. So I do think if we do see that kind of meltdown, the cash and carry trade unwind, there will be signs beforehand. So if you're already in position, I wouldn't be pressing the panic button just yet, but be on alert that there's a lot of ways this could go sideways in the coming days.
Well, Ben, I do want to get your take. I know you did a really nice write up on X about the cash and carry trade and kind of synthesize a couple perspectives. Before we do that, we get into that. JJ, what about from an options perspective? That's oftentimes a starting indicator of maybe how some of these traders are starting to position themselves as they're looking at this. So if the dollar is coming in stronger, they're now expecting some weakness in price. Are they changing some of those positions, or are they actually looking at this, place of strength as support, and they're actually going to look at that and go long? Are you seeing any changes? When I looked at notional value for the end of June, it still was sitting, I believe, over 6 million. 6 billion in notional value.
There's just been no signs of life in the options market, like no sign of interest really in either direction for the most part. And what we see historically, if we overlay this here, this is the Bitcoin implied volatility index overlaid on top of the DXY. And you can see when there's a strong dollar, it just kills volatility, sucks that liquidity out. And what you need for momentum in the options market just isn't there. In terms of positioning, there's a lot of puts that entered yesterday, protective, heading into the FOMC event. We can see that pretty clearly here on the green line, which measures the June 12th expiry. So that's for tomorrow. And you can see it's pretty deeply in the negative here, indicating that traders are paying more for out of the money puts versus out of the money calls heading into tomorrow's FOMC and CPI. So the market's pretty well protected here to the downside, but you don't see, there's nobody buying a lot of calls or even puts for that matter. It seems like the market's positioning in that cash and carry trade, long spot, short the futures, and that's the way they're hedging. They're not really expressing views in the options market right now, and there's no signs of life and volatility whatsoever. So maybe we see that tomorrow, if Dixie gives way one way or the other and kind of sets conditions. If we have some kind of read on which way the market's going to break in quarter three, then maybe we'll see some options activity there. But it's just been a very dead few months here in terms of options. Not a whole lot to speak about.
Not a whole lot to speak about. Shut your mouth, JJ. There's always something to speak about. This is
well, one thing that is interesting, and you could see that rush for protection here too. So you see the this front end is pretty spiked up. We have IVs at the money for today's expiry at 75, and then you see next week it comes right back down. So the market's not really expecting any kind of lasting volatility throughout the summer months. It just seems like a lull is expected, and it seems like what the market's positioned for most now is just chop between 60K and 70K forever. So we'll see if that happens.
Forever. Well, okay. I want you to answer the question, but I'm going to ask Ben to weigh in here a little bit on this on the basis trade. But JJ, I want you to answer the question: what actually gets us out of this range? Is it going to be the Dixie finally relenting? Is it just going to be these new buyers coming in? What exactly is going to get us to get out of this range we've been in?
I think if obviously if Dixie continues this strength, we see it move back up towards the April and May highs, then that's your pathway to 50K Bitcoin. That's certainly out of range. I think that's the downside factor. So I think it's all, the way I view the market is all dependent on what Dixie does, right? So I see it as
Yeah.
Dixie gets back above here, we're probably headed to 50K or below. And again, below 104, that's your all-time high fuel. If Dixie
Okay.
starts to weaken, we see more liquidity in markets. Bitcoin's going to take off and do its thing.
So we
But
need those outside forces to play ball.
yeah, exactly that. It's all a measure of liquidity, right? So
AJ, do you see any of this price action today being in anticipation or really about taking position today in light of what's coming tomorrow or the next day?
in terms of people like front running hawkish CPI or something like that.
Either hawkish or positioning in the options market, or a lot of times you can see some activity happening before FOMC where you might see price start to come on down, which is really traders buying insurance to the downside and then kind of unwinding it afterwards, and you kind of see price to change in direction there.
Yeah, we did. So I was speaking with Benjamin yesterday, and around as soon as we got that move up to 70K, you start to see this put skew on the near dated stuff go negative. So expiries that we're trading for tomorrow's expiry through Friday, people start to buy a whole lot of put insurance, and I think we saw that in the washout. The reason why, like, people are just anytime there's an event, people want hedges, right? Because it's the unknown. So I think, price was back at 70K. That seemed like a good level to hedge. You saw some people buying puts there. So the market was pretty well positioned for this drop. We've also discussed the cash and carry. So they have short positions to counteract the longs. In general, the market was well positioned for this drop. I don't think it caught anybody by surprise. And it's pretty typical of what we see ahead of events, right? Like it's typically a bearish signal, as counterintuitive as it seems to see. If you were to see Bitcoin at like 71K right now, heading into all of these catalysts tomorrow, you'd be pretty weary of a washout, right? So it's almost a relief to see it early. Now we need to see the bounce. Whether or not that comes, that's anybody's guess.
Well, Ben, this is a good time to unpack this basis trade that everyone's talking about. There was a lot of information going on around on X, people asking questions about what this basis trade means. Is it pinning Bitcoin in this range? There was a tweet from Mike Alfred. By now, many of you know that hedge funds have put on a massive long spot short futures Bitcoin carry trade, trying to pick up pennies in front of a steamroller. There are 30 billion of short positions to liquidate around 72,000 on Wednesday. We could see some fireworks. Prepare. And I think there were some other commentators really mentioned this is a delta neutral strategy for people to, in fact, yes, pick up some pennies, right, to gain some yield on this. But it's a pretty popular trade. You, I think this morning, or perhaps it was last evening, put out a really nice analysis. Can you walk us through what this basis trade is and whether or not it actually is pinning Bitcoin in this range?
Yeah, it was interesting discussion. This comes up, I feel like every cycle, usually a couple times. This is kind of the first time I've really seen it get popular on the timeline. And oftentimes there's a lot of truth to it. And I was curious because there was a comment that really discussed, I would say it almost conflated the fact that there was a lot of leverage traders. And so there's a statistic. If you go ahead and look at the COT report from the CME, right here, you can see there's a lot of leverage money that's short. And so I think there was almost like a leap of logic there that if it's leveraged money, then they must be buying essentially spot ETFs and then using that as collateral to then go ahead, leverage it, and then short it on the CME. And is that really happening? I have some doubts. And really, for me, it just came down to seeing that category that of trader, the leveraged money, and looking at their short positions over time And you can kind of see, like, right at March 11th, kind of that week where the market topped out, you really saw an uptick in those short positions. Now, is that indicative that somebody is trying to capture? I mean, this is March, so they're probably playing the June contract. That was kind of what other individuals were saying as well. To me, the spread wasn't really big enough to essentially pay the borrow on that position, and that's what really was the red flag for me. Like, if somebody's going to go ahead and let you borrow capital with underlying collateral as Bitcoin, you're not going to get the most favorable terms as you would if you were holding treasuries or cash. And so, what would those terms be at that point in time? If you guys remember, JG and I were talking about kind of how big funding rates were getting. The cost to borrow stable coins at that time was north of 40% APY. And Bitcoin was pretty high as well. I know OTC desks were having trouble sourcing Bitcoin on the market. So if when we think about rates, like, was that opportunity really there in March? And I'm hesitant to think so. If anything, the market was overheated. It was showing signs of exhaustion. Leverage traders were just using leverage
Mm-hmm.
to go ahead and short Bitcoin, in my opinion. And there we see it again happening right now. The market was trading sideways. Anybody that was looking at order flow over the past week, it's been a very slow market. Like, trying to get a bid filled in this market was like watching paint dry. And because of that, if you're a trader and you're using leverage, why would you not take a short on that? To me, it just, we're like trying to connect too many dots that don't really exist
Mm-hmm.
in the market right now. And this was a case in point. And this is why I follow rates so much, because it gives you a little glimpse into, like, if certain trades are possible at certain times, as well as when those arbitrage opportunities do show up and those rates are getting kind of excessive, then people are moving essentially their trades or their positions to go ahead and capture that arb, and they're not necessarily playing the spot market, which means that price directional opportunity is not as obvious and played.
There was a
So
lot, yeah. Like back in March, you could sell the December futures for like 90K, right? And Bitcoin was trading at 70K. So that's an obvious spot to do a cash and carry, right? Where you're
mhm.
long spot and then you're selling basically you're selling your future Bitcoin for $95,000 and you're locking in that money. Here it's not as juicy as it was. So to jump through all those hoops and the difference between what they can get as a risk-free rate, just in bonds or whatever it is, 5.5% versus doing all of this complication to buy Bitcoin, borrow against it, short the futures. I don't think it's as popular as people believe it to be right now. There's definitely a lot of people doing it, but I don't think the entirety of this open interest that we see is purely cash and carry trade.
So it's really, I mean, just to summarize here, it's not what's pinning us down in this range.
I think it's just natural. Just we got really overheated. Borrowing rates were insane. We had meme coin frenzy, and traders were borrowing stable coins to essentially, push it right back into meme coins. You saw on Solana, a lot of traders were leveraging their Sol tokens. Prior to that run, the leverage ratio that we have in house was really healthy. It hinted at a good sustainable rally, and then it got overheated and it never really corrected. And we've kind of saw the drawdown take place on Sol as a result, because there really was no more dry powder in that ecosystem
So
in terms of using collateral, borrow stable coins, and then push it right into meme coins. I think
Mhm.
Benjamin likes to talk about that a lot, of like using Bitcoin as collateral to go ahead and go down the risk curve on meme
Mhm.
coins and other altcoins.
So I'm looking up some of the annualized basis rates right now in OKX and Binance, which are the largest in terms of volume. When I look at coinanalyze.net, sitting at 9%, 10%, 8.4% annual on an annualized basis. Those expire in 107 days and 16 days. What if this jumps up, to 15%, or this drops down to 5%? Ben, how do you interpret that And does it give you any signal relative to where the market is? Like, if it goes down to 5%, is that really a really healthy sign for the market for getting up to 15 to 20? Because I think that was what it was several months ago. That's where you start to get a little bit worried that we're too frothy.
When we get down to 5%, you're saying?
Oh yeah, if we get down to 5%, is that kind of the healthy reset that we need before we get the next leg up?
Yeah, absolutely. Because you're moving capital and you're moving dry powder into probably safer forms of yield, which would be treasuries at 5%. And so, if anything, that just acts as dry powder ready to make its next move so that when organic, demand, essentially spot buying as the predominant pressure that would see in the market, like once you see that sort of push and demand take place, that dry powder comes off the sidelines. That acts as essentially your secondary push into the market. And if individuals are putting all these different trades on, then that flow of capital isn't happening to act as that kind of second and third wave of capital into the spot markets. So moving through all those hoops, as JJ said, like that's a lot. You got 5% yield right now in treasuries, and you have to go ahead and figure out how much you're paying to borrow against your spot Bitcoin ETF holdings and
Yeah.
put this trade on. I just think it's a little overblown. Granted, there was opportunity. Like, let's not totally discredit it. Like, there was, as JJ mentioned, I mean, you take the difference between a certain contract and what the spot market's trading at, and then you annualize that. It's, there was definitely those opportunities. But if you look at the timing of everything, I don't think it was as large as I think Twitter's making it out to be.
Yeah, I think people look at it and they're like, people just started entering this trade last week, which I don't think is the case. I think you probably have a lot of crypto native funds that are just locking in that whatever it is, 10% for the remainder of the year, hedging themselves ahead of tomorrow and the end of Q2. I think it's more so that rather than like, oh, institutions just entered last week, bought up a ton of spot and shorted the futures. Like, I don't think it was something that came about overnight the way people are kind of reading it in to be. And there's also like, I think a lot of that short squeeze stuff is overblown too, because it's almost like the only way this blows out is if Bitcoin goes to like 120K tomorrow and those futures are priced at like 200K. Like if you short the December futures, Bitcoin moves up to 120K and those futures go through the roof, then you're down a whole lot of money on the short end. But that's like a very outlier scenario, right? And
Right.
people like it's a good narrative to believe that there's some massive short squeeze on the horizon, but it's not the way this market is structured, unfortunately.
And it's not like there's longs either. Like if I scroll this chart up, you can kind of see the positions on the short side with the leveraged money, and then you move up to the long side with asset managers. They're taking the long position. So I believe this has to do a lot with some of the futures ETF products that are out in the market. But regardless, like this is a pretty evenly distributed positioning on the CME. So it's nothing that's kind of got a dislocation taking place.
Every trade is a counterparty, right? And that's what people forget about perpetuals, is there's always somebody on the other end of it. It's a zero-sum game. So somebody's short, somebody's long.
And if you think of it like running a race here, like if you think of rates as essentially how much fuel you got in the tank, like how long can you run at 20-30% borrowing rates or rates in general? You can't. If the rates come back down to 5% in general, market wide, everyone's getting a rest. And because they have a rest, they can now run faster into the next leg. They can have that sustainable momentum that drives markets to all-time highs and have those parabolic runs and have those opportunities go into smaller ecosystems. So like this is great. We've been saying consolidation is really healthy. This is why. It just the dry powder that starts to get ready to move into those opportunities, this is a healthy thing. This is what you want to see.
Okay, so I just want to summarize it here because there was a lot of really good unpacking of this basis trade. It's been around a while. It really isn't what's pinning price down, most likely. I think if we're thinking about why price hasn't moved above, we've got a heavy dollar, which is just putting a lot of pressure on risk assets. And we're not seeing a flood of new buyers, even from an ETF perspective, even though some of those volumes are higher. When those things change, a weaker dollar, where we see an influx of new people, obviously the numbers are going to change, which we're all looking for. So All right, I think that's a good point right there. Let's pivot a little bit to talk about opportunities. Before we do that, we do have a question here, and it just comes up as a non. But if the entire world's fiat currencies weaken, even if the Treasury prints more USD, does the Dixie get stronger? JJ, thoughts there?
Remains to be seen. The market will tell us, right? You just follow the Dixie chart, and that's going to tell you all you need to know. So if you see it gaining momentum or losing momentum, I just view this as a proxy for liquidity in markets. And
Okay.
until this inverse correlation between Dixie and Bitcoin breaks, there's no reason to believe otherwise, in my opinion. So when Dixie's up, you can view that as Bitcoin's going to get weaker, and when Dixie's down, you can view it as Bitcoin getting stronger. But I would tend to assume that Dixie is going to strengthen if other currencies weaken. That's kind of it's a basket of different currencies, right? So you have like the yen, the euro, etc. So if those central banks are cutting rates and the Fed keeps rates pinned or even hikes further in the future, you're just going to see Dixie get stronger.
Yeah. Regardless of some of the debt raises that can happen. So
I mean, that stuff that's more like long-term horizon.
Sure.
As all that eventually it will, right? Like something has to give. But
Mhm.
if you try to guess on the 1-minute chart about that, you're going to find yourself in some trouble.
Okay. The cleanest dirty shirt. Continues to look the best. Okay. Okay, he says, yeah, I think that touches on what I wanted to ask, which is what are the fundamentals behind it? Thank you. All right, let's shift a little bit to positioning. So I'm looking, as we're having this conversation right now, Bitcoin has slipped below 67,000, still obviously in this range of 60 to 70. Seeing a lot of pressure, 3 to 4% off in the 24 hours, and if we're not seeing much on the Dixie in terms of weakness. I think the narrative is this is going to put a lot of pressure on risk assets, particularly Bitcoin and the rest of the ecosystem. So JJ, how are you thinking about options right now? Obviously, if you're not, you've got the ones that maybe you already had, positions you already had open, but what about other positions that you may be looking at as the market starts to weaken and you see some pullback in these major cryptos?
Yeah, as Dixie's moving this way, I think you just kind of you want to let the market come to you here. Like Bitcoin's obviously lost a lot of ground, and if it is going to recover, it's going to give you I don't think it's going to go straight to all-time highs from here tomorrow or anything. So I think you'll have some time to get into position before that. In terms of the downside, I don't think you want to be shorting necessarily. Again, as we said, this is directly into support, technically, right? So, not to say it can't break lower, but you don't want to be betting on that ahead of an event like tomorrow, where there's definitely going to be some chop in both directions. I think you kind of want to wait till the end of the week before entering any positions. I don't think there's really a clean signal right now, and I think knowing that is probably an advantage, right? You don't want to just be throwing money into the wind, guessing on these things here. If you do say if you still have conviction in all-time highs, I think you just want to keep an eye on September, December, those quarter 3, quarter 4 contracts somewhere above all-time highs, and keep an eye on them in the coming days. And if you feel like Bitcoin's reached a bottom, you could start looking at like these $75,000 calls somewhere above all-time highs if you think we're going to get that 100K break once the strong Dixie's behind us. So if you feel like you have an edge there, I think this is probably a good range to be looking to add those over the next day or two.
Okay. Hey, producers, just FYI, we are seeing some feedback from the audience. Oh, looks like the screen's back on, saying they couldn't see JJ's screen, but maybe we've got that back. So really, it's making sure you don't get steamrolled. Take some of that dry powder and be prepared. What's you mentioned waiting for the dollar, I think, to sort of make its move, tell you exactly how strong it's going to get from here. Is there anything from a Bitcoin perspective? Are you looking at maybe any price levels where you'd start to get confident? Or does it really just the Dixie has to tell you what you're going to do?
I look at it as the Dixie, and ultimately tomorrow's going to be a pretty pivotal day. Like, will we see this support retested, and does it break below 65K? And how far does it go if it does lose this level, right?
Yeah.
So if you enter an options position today, and then you wake up tomorrow at 8:30 o'clock or 8:30 when CPI is released, and we're down at 60K, you're down 80% on call options, right? Or
Mhm.
to the flip side, if you buy some puts now and then price spikes back up to 70K, you've lost all of your money. So you don't really want to gamble into these, but inevitably are volatile events, right? Unless you know for sure you have an edge. For an example, like last time there was a CPI, we did take some risk on calls because the dollar was fading, right? So you had a pretty clear signal here. This was here it is, Tuesday before CPI in May. So Dixie was fading, right? It was in a clear downtrend, and it looked ready to peel over. Bitcoin at the same time was strengthening. So if we look at where Bitcoin and Ethereum were at that time, they were right around this range, and they were showing some signs of resilience here after making basically what was a low in May, and then we saw some bottoming signals, and it just looked like a low risk, high reward. And here, I just don't see that same setup. So I would rather wait until it's a bit cleaner to begin taking risks. And I don't see the same setup that I saw heading into last month's CPI now. Not to say can't be extremely bullish tomorrow. I just don't see it. And if I miss it, I miss it. But
Yeah, you're waiting for confirmation.
yeah, exactly.
We had a question here from JB. What about ETH? I'm guessing, JJ, that you're going to say it's just more of the same from a Bitcoin perspective. Is there anything unique looking at from an Ethereum perspective that would make it a different trade in the moment?
It's not a great looking chart here, right? We kind of lost this parabolic structure that we formed a few weeks back. It's hanging on by a thread here, hoping that we don't break down to below. It looks like it wants to go to 3,200 if this Dixie strength keeps up. But again, what have like there's the influx of short open interest right now. There's a whole lot of cash and carry going on. There's de-risking ahead of FOMC. There's a lot of factors right now that could cause this to snap back. I'm just not in a rush to bet on it right now. Like you just want to see a bit cleaner setup and knowing when the odds are in your favor. And I don't see a setup where the odds are necessarily skewed one way or the other right now. So I think that's part of the game, is knowing when you have an edge and when you don't. And I don't see an area of edge here.
Don't overtrade, especially if you don't have an edge. Okay, appreciate that, JJ. If you're enjoying all this options opportunities that JJ's walking through, and you're interested in starting your options journey or just continuing it on a new platform, definitely check out CoinCall, where you were just seeing the options chain, and it's all in the options video that JJ does. It's a great place to start your journey because it's got a very elegant interface and competitive fees, exactly what you need if you're going to be going down the options path. Definitely check out the link in the description for the show. For those who are in here already, hopefully who are joined us already and on Cyber, you know where to find that. But we can definitely direct you afterwards in the AMA that we're hosting right after the show ends. Ben, we're gonna wrap it up with you today. So JJ just walked through, I think, what looks like a very bearish near-term kind of setup on these markets. Not really anything you should be buying into. I think you've talked about sort of looking at some L1s. Is there anything that you're looking at here? Are you kind of following JJ's path to where once this snaps back, maybe takes some options calls? What are you looking at? What's on your radar?
So a week ago, the discussion was really around the market was on a shot clock for anybody that was there. And Bitcoin really needed to giddy up, and it didn't. We saw it kind of flounder at the end of last week, and now we're seeing kind of the response because it wasn't able to go ahead and make those new highs. And this is a bit of liquidity engineering, right? Though I mentioned the order flow, the books were just really paper thin. There wasn't really anybody being aggressive in the books of late. And so now we just kind of need to reinvigorate the market. We're engineering the liquidity. And I think JJ just really spells it out best. Like, why take any risk more than you need to? Let the market kind of find its feet. I pulled up right here the Bitcoin dominance chart, and there's some vertical red lines on it, and those represent Bitcoin's halvings. And I kind of made these downward arrows to show like when the market really goes risk on for the beefiest part of every cycle. And it takes time. We see it was, the halving was in 2016, and it came in 2017. We finally saw dominance break down. Then we saw halving in 2020. And then it really wasn't until the turn of the new year in 2021 where the dominance really kind of the floor came out. And so here we are. It's June. We had the halving in April. So you kind of line those things up, right around the end of the year, kind of Q4, you would really expect the floor to kind of come out. And if it doesn't, we kind of got to start asking those questions. Why is this is this a different cycle? Why is BTCD not acting as it was prior? Because and I say once it does, because I do fully expect this to break down. I would expect this to go down to like 30% dominance in the market, just because the ability to move to all these different assets is so much easier than it was in prior cycles. So waiting for kind of that confirmation of where the market is at, having its feet kind of set on a solid foundation in structure, and then making those positions. And so one of the things I'm looking at, like I think, so BNB, I made a note to some of our clients that we have this is kind of a tip of the hat to some of the work we've been doing on token ratings. Token ratings is kind of this way to rate various layer one networks to understand which ecosystem is showing a lot of strength in the fundamentals and the technicals and even the network statistics. And once the shows strength, then you can kind of move into what projects, what tokens are driving the narrative on those chains. And so that's really the focus of that research. And so with BNB, it was making its run. The chart was painting this really bullish structure. It went ahead, made its breakout, but we were having a divergence on the ratings. And so it felt like a bit of a false breakout, and we're seeing it retest. And I don't see any follow through at the moment on a lot of the on chain fundamentals, even the network, which, for BNB, like the main narrative last cycle was that it was cheap. And so retail was able to go over there, have the meme frenzy. Well, this time around, Binance chain is not that narrative. I don't really know what it's used for at the moment, to be quite honest. I see Solana kind of taking that narrative away from it. A lot of individuals left Ethereum. They went to alt EVMs and layer ones, and they went to BNB. Again, I don't see that happening. I see L2s fighting kind of against Solana for that narrative moving forward. But what I also want to see before I even make that approach and going down that risk curve is I really am concerned, at least for Ethereum, this battle against L2s. It's kind of having this moment of, kind of hitting puberty in a way, right? It has to go ahead and create enough gas fees on its main chain, on the mainnet, and it's not having that take place. So how can it have this price appreciation take place if it's not requiring a lot of gas spend on its main chain? So L2s are getting all the activity. Somebody had a stat where all the L2 users relative to kind of Ethereum, and you could see a lot of users have moved to layer 2 chains. And so they're having this little bit of kind of coming into adulthood moment. Will they go ahead and overcome it? We'll see. But for us, we have one of our models being price level score, and that has to do with essentially how much computation is taking place on the layer one network. Kind of acts as like the same way that like CPI would act in economy. You can kind of see like how expensive the economy is at large, and it's not right now. We don't have any like demand pressure taking place. You don't see this request for higher forms of productivity and computation on the network. And so until that happens, Ethereum's in a bit of a pinch. And of course, this can all change on the dime if the ETF gets approved and things start moving. We're going to have a flywheel effect once that happens, is my guess. So it's a waiting game. That's a long-winded answer for saying it's a waiting game. But, looking at the dominance chart, that can give us a little bit of help to remain patient before we go ahead and, start moving down the risk curve.
Okay, there's a lot to unpack there. I think for all the listeners there, hopefully you can rewind that and kind of unpack a lot of what Ben just said. I think to sum it up, though, it's really this is a time to be risk off. If you're trading, if you're holding spot, and you've been doing that for a while. This is a time where you just want to allow the markets to do what they're going to do, turn off the computer and walk away. If you're looking at some trades, definitely be looking for some validation coming in from the Dixie, showing some strength. That maybe there's an opportunity, or sorry, the Dixie showing some weakness, then risk assets being able to show some strength.
I will say what we're seeing in the spot order books now, particularly here on Binance, if you can see my screen, it's pretty interesting in that last week, as we got up towards that 71K region, we saw a whole lot of ask liquidity, right? So a whole lot of people want to sell 72K. And you see that visualized here in these red blocks. These are basically sell orders. And then as prices fallen, now we kind of see these bid walls entering just below current price level. And the ask walls, the sell walls that were there prior are no longer there. So this is a good sign. We just need to see it continue into tomorrow. So from a spot perspective, again, like nothing's changed. It's just you don't want to be too distracted by what happens day
Right.
to day, like active traders are. But in terms of this, it's like Ben said, engineering liquidity. Price had to get to a level that's attractive for buyers. It seems like we may have found that here. But again, there's a lot hinging on what happens tomorrow and ultimately into the end of the month in quarter two.
A lot hinging on it. All right. Well, with that, we're going to wrap up the very first show in XC 2.0. Ben Lilly and JJ, thanks for being here. And for all those who joined us in the studio, stick around. We're going to have an AMA special just for you guys. Say thank you for joining us. And for all those out there on YouTube, be sure to join us in the studio every Tuesday and Thursday so you can actually join in the AMA, ask your questions and all that stuff. But with that, I'm going to leave you with the same PSA I do every episode, which is to have some dry powder. We just walk through the reasons you want to have it so you can play those trades. This is Marconi White signing off.